Jeff Kilberg, co-founder of KKM Financial and a frequent CNBC contributor, is on. Where are you today, though, Jeff?
I am in Chicago, Lee. Happy to be here. It's about 90 degrees, a little toasty out here, but stuck in Chicago for the short-term future, my friend.
All righty. Before we get to it, just a couple of logistical items. You can send in your questions in the Q&A functionality underneath the presentation window. Your questions are private, will only be seen by Jeff and myself. Keep our eye on them to make it as interactive as possible, but we can't always get to all questions due to the number of people on these sessions. We also have our written disclosures. As much as we'd like to have Jeff work for us, he already has another gig. Again, he's head of KKM Financial. As I said, he's a contributor on CNBC, and they can see your shining face on CNBC coming this Thursday. Is that right, Jeff?
Yeah, that's right. Yeah, I'll be on the halftime report. So, tune in if you can. Halftime report is 12 to 1 Eastern.
Awesome. All right. A couple of other disclosures. Everything Jeff and I talk about should be considered as educational and informational in nature only. Nothing should be construed as a personalized trading recommendation. Any expressions of opinion that either of us make could change at any time based on market conditions. We look at a lot of charts, but we do not recommend the use of technical analysis by any means as your sole method of investment research. We also look at ETFs and ETNs, but if you're going to trade those products, read a prospectus. And finally, we look at futures contracts. If you're going to trade those, do take the time to read the risk disclosure document for futures and options. And with that, I'll put up the heat map here. Let's make it a little bigger. And we'll just review the news flow. And Jeff, feel free to interrupt if I miss anything. All right. Overseas, starting in Asia, China appears as still falling short of their phase 1 purchase commitments for U.S. goods. And also, U.S. tech companies have said they will suspend processing data requests made by the Hong Kong authorities because they passed that security law. Also, the U.S. is looking at banning TikTok and other Chinese social media apps. Secretary of State Mike Pompeo said on a Fox News show, TikTok, as you might know, is owned by Beijing-based ByteDance, and he's been on the radar since last year. The fear is that they give their data of users to the Chinese government. In Asia, though, it didn't hurt the Chinese markets. They're still up another 0.4%, though there was some weakness in Japan, down 0.4%. India was up 0.5%. Turning our attention to Europe, industrial production in Germany came in significantly weaker than expected, unfortunately. So this is interesting, Jeff. They've done better at handling the virus than we have, yet their economic data isn't really showing much outperformance. What do you think?
Yeah, it's pretty fascinating to see that. And it was interesting. There's a note actually out today, Lee. I don't know if you saw that note from BlackRock. BlackRock talked about going neutral on U.S. equities and getting more exposure to European equities. So we talked, for many, many years, it's been that massive dispersion as we've seen U.S. equities continue to attract assets. But it is interesting to see that there's a little bit of a spotlight going on Europe, despite the fact that data is weak. The cases and the deaths and all the data coming out in the wake of COVID-19 has been better for sure.
Yeah, and I was on with our Director of International Research last Tuesday, a week ago, and to your point, they were getting more positive on Europe too.
Well, yeah, and it's interesting, Lee, right? I mean, there's been more positivity on Europe, and that's been not just a 2020 theme. We heard that in 2017. We heard that in 2018. We heard that in 2019. And we're still seeing that dispersion between the major indices in both continents. So will we see that reversion to the mean? Will it come back and narrow? Well, that's why I think BlackRock and some of the other folks are talking about adding exposure to the weaker one, Europe, and lessening up on exposure to U.S. equities, which has just been dominant.
Yeah, that's I didn't see that note, so thanks for bringing it to my attention. That's very interesting. Let's talk about the virus. So just out not too long ago, Melbourne, Australia has now issued a 6-week stay-at-home lockdown as cases continue to rise in Australia. Also, Carnival Cruise just came out and canceled cruise itineraries for some destinations for this year and next year. That's what I thought was kind of weird. Yeah. Also, so Dr. Fauci came out and said that we are still knee deep in the first wave of the virus. Um, also,
No, that's been the interesting thing, right, Lee? I mean,
yeah,
no one can really measure or gauge how state and local economies reopen, let alone global economies reopen. And we did see in Miami, they're talking about reclosing some restaurants that have been open. So this is the fits and starts. That's why I think we see the elevation of volatility remain in the marketplace, despite the fact it's the week after 4th of July, which is historically a pretty snoozy type of week of trading. So yeah, people are still on high alert, and there's anxiety radiating the marketplace as the VIX kind of seems tethered around 30.
yeah, that's really good observation. Also, to your point about them rolling back in Miami, also Los Angeles County reported almost 50% of the new cases are with people between 18 and 40, and also hospitalizations for people in that age range has increased from 10% of hospitalized cases to 25%. New York also entered phase 3 of its reopening plan, allowing nail salons and spas and massage therapists to resume operations, and they're easing restrictions on playing basketball, volleyball, and handball, among others,
Well,
in
Lee,
their
that's good
parks.
news. I know you love the hair salons in New York, but just to talk about some of these different reopenings, it's really interesting that we are going to see these fits and starts. But at the same time, we have seen some data and the actual fatality data diminishing, weakening. So yes, there's an increase in cases. Yes, there's an increase in testing, but I think that's a pretty important and potentially, that's what the market is overlooking, that new data there, because they're focused more on the lowering of the fatality rates due to COVID-19. But it has been just a melt up here. We talk about the NASDAQ 100, just a rocket ship, continues to make new highs. I think yesterday was the 24th record high for the NASDAQ 100, and intraday it was up higher against it. I know it's giving up the ghost a little bit right now, but it's interesting to see what matters to the marketplace and what doesn't.
Right, and I've actually got some data when we go over the market about what those streaks in the Nasdaq portend from some backtesting data. We'll talk about that in a sec. Okay, domestically, we had the JOLTS report. It was actually a little encouraging. Layoffs tumbled from 5.9% in April down to 1.4% in the recent report. However, there still are 4 unemployed Americans for every job opening. But typically, I think you'd agree that report usually doesn't move the markets very much.
Agreed.
Yeah. In Fed speak, we had Atlanta Fed President Bostic said he is, quote, getting nervous, unquote, about signs that economic activity is leveling off. Also, just a little while ago, Mike Pence's top aide said that the White House wants Congress to pass more stimulus by the first week of August, but they want to keep it under $1 trillion. But $1 trillion here, $1 trillion there, it does add up for sure.
Remarkable. Yeah, we are throwing around the word trillion. It's interesting. I think that's been the big undercurrent, right, Lee? You've
Right,
seen $3 trillion hit the marketplace in 3 weeks. That was like QE1, 2, and 3 combined, which took
right.
18 months, nearly 2 years. And I commend the Treasury and the Federal Reserve on how swiftly they reacted to this acute pandemic. I mean, we've never dealt with a pandemic before, so now we're really trying to gauge, and maybe that's part of the equity movement higher. It certainly is, I should say. It's part of the equity movement higher, but more additional stimulus. I think we're going to be addicted to more additional stimulus in the same way we were the post the Great Recession. So the market is going to demand probably more of this, but I think the Federal Reserve is going to err on the prudent side, and we're going to hear a lot of Fed speak this week. I think there's 3 or 4 different Fed speaks this week. So I think it's important to monitor the Fed speak because that will shape policy moving forward. And as we know, Fed policy is the captain of this boat.
You got it. That's a good way to say it. All right, let's take a look at our commodity review here. Let's start with gold. We've been monitoring this one for a breakout. It broke out before, then it came back a little bit, but today looks like it's trying again.
It
And it
is
looks like,
above 1800. I think it's really
yep,
interesting. And now it's interesting. We have owned gold since December of 2018, but just 2 weeks ago, our relative strength, we use a lot of relative strength point and figure analysis, revealed that it fell out of favor. So it wasn't exuding that relative strength, that technical strength that it usually does. So we have not been short by any means gold, but we haven't participated in the last $40. So I'm a little remiss about that, but nonetheless, the weakening dollar, a lot of the gold bulls are wondering with such a weakened dollar and such a safe haven and such a Fed stimulus, why are we not at $1,900? Why are we just peaking ahead above 1,800. So it's a valid point, but nonetheless, gold continues to grind higher.
Yeah, that's right. Let's take a look at, not everybody trades the futures. It's interesting that the bullion itself, as opposed, in the ETF GLD, it never did actually go back into the range. It just kept going higher. It's making yet another high here. So,
Right, right.
yeah,
And the gold futures are really interestingly when we talked about the March Madness that we all had to endure when we saw correlation go to one and everything was sold off. And those gold futures, there was a day, it was after 3 days of equity carnage when we saw those circuit breakers tripping in the S&P 500. What happened to gold? Gold was trading about 1650 during that moment in time. Well, people needed to raise cash. There were margin calls and all different types of accounts. So gold actually went from 1650 to 1450 in a day, and then whoop, it resumed back above 1700 and went on its merry way. And here we are above 1800. But gold certainly has historically always been a safe haven. Does not yield anything, but it should grind higher with all the central bank stimulus, not just in the market today, but look at all the central bank stimulus that's about to come in the market, as typically we see other global central bankers follow our Federal Reserve lock and step. At least they did post 2008.
yeah. I love your take on this. This is not a scripted question. I just want to know myself what you think. Uh, you think some of this is that some traders are looking out longer term and just saying this stimulus is going to cause inflation at some point? There's certainly no signs of it yet, but what's your feeling on that?
I think the Fed would love to have that a reality. The Fed's been looking for inflation for over a decade. But I think when I look at this chart here, the fact that we have not seen gold move higher, either from inflation scares or from the safe haven trade or just from the weaker US dollar, I'm going to go back to my pit days. I spent over a decade in the pits in Chicago trading all different types of futures in the treasury market, the 30-year, the 10-year. And there's an old saying, Lee. The saying was, if it stalls, it falls. And the fact
Ah,
that we're seeing gold stall out a little bit here, I'll be interested to see if we can buy gold back a little bit cheaper here. I'm not abandoning, I'm certainly not going to be shorting gold, but I think you're going to have a better entry price potentially later in the summer.
oh, excellent. We'll keep our eye on that then. We got a question on silver, so let's take a look at the. Let's
I
take a
hope
look at.
silver. Here we go.
Yeah, okay.
And
We'll talk
interesting about
about
silver and
stalling.
gold.
It's not
Yeah,
doing much, is it?
but look at the ratio. You don't talk about this enough in my mind. The gold to silver ratio. What is the cost of how many 1 ounce of gold divided by the price of silver? And that ratio was over 100 just a
Right.
couple weeks ago. It's come back in at 96 and a half, 97, as you see right here. But this is historically very, very high. So the higher beta silver, you would think there'd be some reversion to the mean and it'd make a lot of sense to own silver. But that's been the conversation for almost the last 12 months, and it hasn't really kicked in. But if we do see the precious metal demand, and that's the one thing I think is really important to separate here. Gold, inflation scare. Gold, central bank stimulus. Silver, a little bit more industrial demand here, but it does have the ability to really kick in if you're right on silver. It's a higher beta way to play precious metals, no doubt about it.
Okay, we got a question. We want to look at the gold miners too, so we shall do that right now. Threatening to break out, hasn't yet. Um,
Miners have been interesting. They feel like
yeah,
they are poised to go higher, and even GDXJ, which focuses on the junior miners, it seems to be, both of these are lining up for a bit of a breakout. We just um, haven't seen that event yet, Lee, and I don't know what that catalyst is, but they're both very similar looking charts. And we are seeing DXJ peak his head above. That's interesting.
yeah, just right now. Yeah, so yeah, we've kind of been constructive on those here on charting the market, so they seem to be getting a little bit of a leg there. Let's take a look at the doctor.
Dr. Copper, I think he's back in session.
He is. He is. Look at him go.
He's seeing patience again. If you look in the month of March, if you overlay that in the equity market, when you saw that demand pick up and the price of copper move higher, you saw the equity markets globally kind of lock and step follow. And now it seems to be a pretty consistent bid and it's broken out here. And it's impressive to see this chart.
It is. We mentioned the breakout keeps going. At least you can say that the copper market is not giving a negative divergence to the equity markets, which all in all
That's
is,
right.
it's a positive, right? And probably a lot of it has to do with we had some stronger data out of China. They're the biggest user, so maybe that's what's going on. All right, let us take a look at oil. I know you wanted to talk about that a little bit. We'll put up the
Yeah, crude oil's been really interesting. Obviously, we had all different types of price discovery a couple months ago, but here we are seemingly tethered to $40. And this certainly goes to, there's a supply story, which is just a long, boring story. We've heard OPEC, not OPEC, curbing production. That's been going on for years. But finally, the supply goes to the back burner and the demand comes up to the front and center part of the stage. And right now, it's interesting. I think it's pretty constructive to see the way it's poised to move higher. Be interesting if we can break out of this range and get above 42. And what's really helping crude oil, Lee? The U.S. dollar, in my mind. I think that's been a driver as well.
yeah, the lower dollar helping the price there. Yeah, although we'll see that the let's take a look at the XLE. It hasn't been doing quite as well as we would have liked. Range bound
Well,
now.
let's cherry pick. Let's cherry pick that, right? If you look at the last 3 months of XLE, it's doing great. But if you look at year to date, it's the worst sector in the S&P 500. Energy is still just getting crushed, down 37.62%. The second worst sector is financials, but energy. We haven't touched energy in a long time. But we run a lot of ETF model portfolios powered by Nasdaq. Dorsey Wright. Dorsey Wright is the guru of point and figure analysis. And believe it or not, Lee, we bought energy about a month ago. So we own energy almost 6 weeks ago, I would say. We own energy and we also own natural resources. So these have been two interesting exposures that you typically wouldn't think, but they are showing some relative strength. And I think as long as energy stays poised and tethered to $40, you'll see continued attraction into this very beaten up, potentially oversold space.
And what do you use to get your natural resource exposure?
So we utilize, it's an iShares ETF. Let me pull that up right now. But the iShares ETF that we use is kind of gives you the exposure to the big names, So it's Barrick and it's all the different models. So let me pull it up right now and I'll give you the top holdings here.
Okay.
But natural resources has been something that's been neglected as well, right? I mean, it's been, I want to say IGE, but I'm just actually refreshing my computer. This is the beauty of working remotely. I don't have that ticker up right here.
Right.
But we have seen we've seen a lot of different energy space. Certainly we've owned Chevron through the thick and thin, and it's been tough to see some of these energy names specifically have exposure and get beat up. But in the same notion, when you see these ETFs finally take a position. And if you look at, it's the oil and gas exploration one, IEO. And then we also do have the U.S. oil equipment and services. So IEO and IEZ.
Okay. So that gives you a pretty broad exposure then, huh?
It does. And if I pull up, what's nice about IEZ, it's not a ETF you typically think about owning oil equipment and services, but these are all names that you basically know. These are Schlumberger, Halliburton, Baker Hughes. There's a couple smaller companies in here, but those are the big weights. Schlumberger and Halliburton make up about 50% of this ETF. So it's time from a technical perspective to own these names, and we like owning them in a broader swath from a little bit of diversification perspective.
Awesome. All right, let's take a look at our bond signal and see what the 10-year is doing today. Talk about range bound.
Interesting. Yeah, it doesn't seem like, in my perspective, I don't know what the catalyst is going to be to get this over 1%, but it doesn't seem like it's moving. But there is a little bit of steepness, between the 10-year and 30, which is somewhat encouraging for the banks as they are really challenged in this rate environment. But the 10-year really does seem range bound, and this is an opportunity to sell rips and buy dips.
There you go. Yeah, trade it like a range, right? And then let's take a look at our bond signal on the TLT. So if you are following it in a trend perspective, we use two moving averages here, the 20 and 50 period exponential. So I don't know, probably at this stage, I mean, yes, the faster one is above the slower one, a little bit of a whipsaw going on here. I think maybe you want to see if it kind of breaks out of this range one way or another. I don't know, do you have any thoughts on the longer bond?
Well, whenever you see TLT, which is of course tied to the longer bond, you have to be mindful that this market's getting really choppy, it's getting really narrow. So instead of trying to, trade in and out every picosecond of this market, this makes a lot of sense to either put a buy stop in above the range or a sell stop below the range. And by putting a buy stop in above the market, that would actually initiate a long position. So right now, as it's chopping around, instead of getting caught up in the whipsaw, you kind of let the market, you be patient and using a buy stop above that gets you long. Hopefully that breakout extends. And if the market does drop here in CLT, then you'd be establishing a short position by selling on a stop to initiate that short position, looking for a little follow through as you go back down to some of those trend lines.
Yeah, I think that's definitely the way to do it, especially since the two moving averages are so close. You're going to get whipsawed if you don't do it the way you said.
They're just getting so close that it gets confusing. I mean, you can have a pump fake and your head will be spinning here if you try to follow everyone when you see that type of narrowing. But what's nice about this chart, Lee, is that when you do see these moving averages collide, in essence, that means they're getting poised and coiled. Whenever you see a market coil like this, there typically is a breakout. We just don't know which way it's going to be.
Right, absolutely. All right, let's put up the S&P 500 here, and I got. We'll go to the regular chart with the regular moving averages on here. We'll put up that. So broke out of this little triangle. You got pretty good resistance up there, though, at 3250. Obviously, the NASDAQ is stronger, but they hear us all the time. What are you seeing around the market here?
Well, the S&P is really fascinating. I was trying to get back to unchanged, and this morning's after yesterday's great day, we did see a little bit of selling pressure. The S&P is down about 20 handles. Fought its way back to unchanged. It was following its big brother, the NASDAQ, which had a 100-handle turnaround. But the S&P 500, I think, is going to start respecting the technicals a little bit. And when we talk about a potential melt up a little bit in the NASDAQ, of course, it's going to bring up the S&P 500 when you look at Amazon. Amazon vaulted above $3,000 for the first time ever yesterday. We saw Apple up 3%. We're seeing all these big tech, these trillion, Microsoft and Apple now are $1.6 trillion in market cap. I mean, it's just mind-boggling to say that out loud. But I think the S&P 500 does have the ability to consolidate and come back and test a little bit. But we did see that consolidation, and it really respected the technicals on the 50-day and 2-day moving average. It went back and tested under 3,000 a couple times, and now we're 5-6% higher. So I think you really have to be mindful of where these averages are, because I don't know if the Federal Reserve is buying on these moving averages, but someone's coming in scooping, and that may be a function of the fact that there was a lot of underinvested, potentially people sold in the month of March. They're trying to get back in, and that was really relevant the last week or so of Q2. We call it window dressing on the floor, but you have to be mindful. There's a big population out there that's underinvested right now.
Yeah, to your point about maybe consolidating a little bit, I looked at some. So we had, with yesterday, we had 5 straight days with gains on the spiders, the SPY, of 0.5%. Looking at the data going back to 93, a little bit weak in the short term, to your point about consolidating. So after 1 week, the market was only up 43% of the time. A month later, the market was only up 29% of the time.
Well, that is interesting. But one thing that people don't really realize, when you see consolidation, I think that's actually a really healthy sign, Lee. When you see consolidation, we call it back and fill for all the former pit traders and all of us geeks who love charts. That back and fill is really important. And sometimes those old gaps get filled in, but that old drop, that old support is now resistance. The old resistance is now support. So this consolidation here, I think, potentially may allow us to take a leg higher. And one thing that's interesting in the S&P 500, we've owned utilities for the last 3 years in our ETF model portfolios, Lee. We sold utilities 2 weeks ago. So what does that mean, 50,000 foot high, or what does that mean in layman's term? It means that the models are increasing beta. They're taking on more risk. They're walking away from the safety of the income stream that a utility provides in a portfolio. And this consolidation may coincide with that thought process, that we have the ability to go test those all-time highs put in February because of the constructiveness, because of the technicals, because of the constructiveness in this chart.
Yeah, really good observations. Now we're going to take a look at everybody's favorite. We'll take a look at the NASDAQ and the Qs. Broke out of the triangle, just making highs. Before I turn you loose on it, I just want to say that we had the same situation with the Nasdaq with the back test. This is very interesting. So when it's been up 5 days in a row with at least a 0.5% gain, guess what? The momentum continued on this one, unlike the S&P. So I thought that was pretty interesting. It wasn't great for the S&P that the Nasdaq kept going, but it's good for the Nasdaq itself. I thought that was really interesting, the dichotomy there. But then, I mean, you can't fight something hitting new highs, right?
No, you can't. I think that's been a theme we've talked a lot on your show, Lee. You know, this overarching theme of this focused rally. And last year, we saw the S&P 500, Apple, and Microsoft contributed to 50% of all overall gains, which was 30% on the year of 2019. Again, this year, we're seeing some of these names, and we look at these. We have a portfolio that we call the Essential 40, Lee, and that Essential 40 does have some tech exposure. We own an equal weight, which has been, a challenge short term. Longer term, we like to be equal weight, but we look at some of these names that just continue to deliver. Amazon's up 65%, Microsoft's up 34%, Apple up 28%, Facebook nearly up 20%. Google's no punk on the year, up 12%. So these stocks continue to attract assets. Why are they attracting so much assets? Well, I think it really speaks to this potential new economy that we're going into. And Amazon, I know my thumb is sore, Lee. We use Amazon's app so often here that there's so many dropouts that we become best friends. I look out my home office and the guy sends me a wave. Hey Jeff, how are you? Just because we're using Amazon so much, but I think there's certainly a reason here. So the reason I'm going a little bit longer here is kind of talk to your viewers about if you've been participating in this upswing, if you've been exposed to technology, that is fantastic. You should continue to have exposure to technology. On our models, we have technology, we have software, we have all the subsectors as well. But for the first time in a while, after 2 quarters of just ridiculous growth, I think it's time to take it back to your weighting. I'm not saying you have to go to an equal weighting, but wherever you started the year on your technology exposure, that may be critical to go back to that weighting. Therefore, if we do see this rocket slow down and lose a little fuel here in the summer months, you do have the ability to not be so tilted, so exposed. But we do have technologies, our number one sector, remaining our number one sector on our ETF model portfolios for the 4th year in a row.
Okay, questions for you. When you said your models took a little out of utilities, where did that money flow into in the models?
So great question. So the models that we have doesn't have any constraints on it. So there were 11 subsectors that we had initially, but now since we sold utilities, we just took a bigger position into the other remaining holdings. So the holdings, and I'll just read them all for you real quick. We have biotech, we have the resource, North American resources, we have the expanded tech. We also have North American tech software. We have consumer services, energy, healthcare, industrial. We have the broader swath, IYW, which is very similar to XLK, which is the broader swath X technology. And then we have semis, so the semiconductors. So by selling utilities, we took out a 9.1% allocation to utilities, and we brought everything back up to 10%. So we just redistributed our beta inside the sectors we want to hold. Now, it's interesting, our sector rotation model, which is available on Schwab. We work with a lot of Schwab advisors and individuals. It's available on Schwab, but it's interesting. In March, what did we sell? We sold financials on March 25th, and we bought biotech. So this model has been, well, I wish I could pat myself on the back. I have nothing to do with it. This is 100% systematic and quantitative and powered by Dorsey Wright. But what's interesting, Lee, is that type of activeness, if you have a tactical type of dynamic strategy, make sure it's trading. Make sure this year, the most volatile year you've seen in quite some time, make sure you have 6, 7, 8 trades. If you have a tactical exposure, you think you have tactical exposure, and you haven't made a trade yet this year, it's time to reconsider what your actual exposure is if you think you're dynamic. So we love the ability to just slightly tweak our allocation, our exposure, and also walk away from sectors not revealing strength and stick with the sectors that are. And sometimes, energy, it was hard to buy that, but again, we're not using discretion, we're using systematic 100% quantitative approaches.
Right. Just wanted, we had a couple questions on the SOX. You say you're in it for sure, and we just wanted to take a look at that. It's breaking out. looks
It
like new
is.
new
I mean,
highs.
it's been a great exposure, and it's interesting to see that whenever you want to you see people book profits in there. Well, sure enough, it comes right back. So this is an ETF which gives you some nice exposure, but from a performance wise, we continue to see outperformance is up over 11%, and these are all names that we know, but sometimes diversification, Qualcomm, Broadcom, Nvidia, Intel. These are names, but you're also getting a little bit of exposure to some names you typically don't have. If it's Skyworks, if it's Maxim, KLA, these are different names in this ETF where we like the fact that you can have 30 different positions instead of just being all in on Qualcomm, all in on Nvidia.
So on. All right, let's look at the small caps here.
Yeah, the Russell's been interesting, right? I mean,
It's kind
it's
of range bound, but it's hanging in there. It
it
just
is,
hasn't broken
and
out.
the obvious component, this is why you bring me on for my obvious observations, right? But the obvious component is that the Russell 2000 is bearing the brunt. All these smaller capitalized companies, these smaller companies, we don't know if they're going to be around in a year or two in the wake of COVID-19. So it's very kind of disheartening to see that some of these companies may not be around in a year or two. However, there's opportunity. There's opportunity in some of these names as they continue to evolve and reshape their business forecasts. And we're going to be going into earnings season here in a little bit. So I'm really curious to see, as every company, it seems like, has dropped their forward guidance. I'll be interested to see what the small caps speak to, because that could be a little bit of a shining light if we do see some positivity out of that for the broader domestic equity market.
Yeah, I got another question for you on the models, since people really seem to like hearing about that.
Sure, sure.
What do you have your cash position, or is it always 100% invested?
So that's a great question. So in our sector rotation model, we have zero cash. We always will be exposed. In our tactical model, we have the ability, so these models are screened weekly. In the tactical model, we have the ability to take a 30% position in AGG. And if you pull up AGG, AGG is the bond ETF, so it will definitely diminish the exposure. So we'll take the equity exposure in the tactical model down from 100% to 70%. Take a 30% position in AGG. In the month of March, this was fascinating, Lee, and this is exactly what a tactical model is supposed to do. We were able to mitigate or not get as much pain as the S&P 500. We mitigated 11%, 1,100 basis points, and that's a big deal. And that was just by and large having a 30% position in AGG, which of course appreciated, but more importantly, we diminish our exposure to the broader equity market in the sectors that we like.
All right. Let's speaking of sectors, let's just see what industries are moving today.
Let's talk about financials. Let's pick on the ward a little bit. Come on, Lee. Let's.
Yeah. Okay. Just because Schwab is in the financials is no
Well,
reason to pick on it.
we're not picking on them. It's just a moment in time. The financials were the vertebrae, the backbone of the rally and the Great Recession. So I think they're coming back. It's just trying to figure out, being more selective. And we actually like, IHI. We like some of these exchanges, some of the, like a Charles Schwab. But the financials, by and large, they're still getting beat up. And I know Wells Fargo has been, a tough slog, but don't even, some of these names like Citi, Bank of America, and JP Morgan, those are longer term holds. And I own JP Morgan, full disclosure, and I'm going to own it forever.
Yeah. So let's take a look at the, so kind of range bound, trying to make up your mind, like you said, around the 50-day moving average there. Let's just take a look at the bigger banks. We'll take a look at the KBE, very similar, although it seems to be weakening here just over the last little bit. Let's take a look at the regionals. Yeah, so, for a momentum standpoint, it's probably not the best place to be. But as you said, for, longer term investment, fine, right?
Yeah, I think if you have the stomach, there's going to be some value out there. We haven't seen banks highlighted, and that's the beauty of, we like the quantitative models that we have the ability to screen it weekly, and if financials come back on, you'll be the second person to know, Lee. But financials certainly have a place in the portfolio. It's just this moment in time, we've been able to create a little alpha in the portfolio by not owning them.
Yes, I can see that for sure. All right. You mentioned the biotechs. Let's take a look at them. They were there you go, continuing higher, right?
They
Tested that
are.
breakout level, continuing to good move today.
Well, Lee, I think it's as simplistic as this. We've seen a global sense of urgency into biotech, into healthcare by and large. But let's really focus on biotech. So, if it's Gilead, if it's all the different players inside of biotech, I think the high tide lifts all boats, but we've never seen this global sense of urgency before. So when we actually bought IBB, when we sold the financials in late March, it was interesting that, that was an opportunity to really have an opportunity to get into some of these names. And if we would have picked one name like Gilead, maybe we'd been better off because, remdesivir. But it's interesting to see that this broad swath ETF is technically showed a lot of strength. It continues to break out. And as we see more and more money get poured into biotech and healthcare, I don't see this theme abating in Q3, Q4. I think biotech is going to continue to run higher. We look at a variety of different names in there. If it's Horizon Therapeutics, some of these names that don't even have a true direct contact to COVID-19, they are participating in the broader swath asset allocation into biotech.
Yeah, it's been a really good sector. We've been all over that. Let's see, we got a question. What have you been hearing on earnings seasons coming up? You hear any whisper numbers of how it's going to be or anything like that? You're more plugged into it than I am, I think.
You know what? It's been great. I mean, it's all over the map. And I think a lot of the analysts, are going to be struggling to really pinpoint what expectations are. So I think analysts are going to have a hard time, but I continue to err on the side that I think we will see some beats. We'll see some better than expected. It's hard to really gauge and measure the price of the stock market to the actual economy, but the stock market is a forward pricing mechanism. And if we see any type of upbeat as we go into earnings season, if we see some continued strength in data or weakening in data on COVID-19, I should say, which would transfer into strength in the stock market, I think that's going to be a big deal. And the lack of forward guidance is really challenging, but inside that challenge, Lee, that's opportunity. So if you have conviction on a name and you're able to do some research either through the Schwab portal or on your own, I think it's going to really present an opportunity to be a stock picker's market. And I'm just fascinated going to this earnings season. I think it's really going to be interesting.
Very interesting. Let's see what, yeah, you can see the biotechs, all the different types, genomics. What do you think about solar? That's been getting a little bit of a bid.
It has. And I think it's going to be interesting to see what the true winners are, right? And we look at some of the names in here. Solar Edge, First Solar, Sunrun. It's a nice diversified ETF, and TAN obviously is the ticker, but I think this gives you a broader swath. But if you have conviction on a certain name, we like to be more diversified versus on one or two names. We like to kind of participate. We may not hit that home run, but we like singles and doubles, Lee.
Yeah, so looks like that could drift up to the new high. So we had pointed that one out when it broke out days ago. Let's take a look.
That's an impressive chart. Hat tip to you on that one. That's great.
Yeah, we already talked about the gold miners. This is another interesting one. I don't know if lithium stocks, they've just broke out too.
Yeah, that's a strong chart, and it'll be interesting to see if there's some consolidation back to that 20-day moving average. But right now, it seems like there's going to be more stops and more short squeezed in this market.
Yeah, plus look how the volume has picked up as we've broken out here. So
yeah, no, that's constructive for sure.
I got another question for you and your models. Do any of, I know you have different programs, but do any of them have international exposure, or are you 100% domestic?
Great question. Our tactical does have the ability to have a 12.5% exposure into the international market. Currently, it's not highlighted. So maybe BlackRock, is talking about getting exposure to Europe, but our models have not signified that there's relative strength being revealed. But yeah, we definitely do have some exposure. We use EFA. That's the ticker for the ETF we utilize in that model. And that's the iShares MSCI. So it's a broad swath exposure, but it hasn't been lit up yet. But I'm envisioning that hopefully coming to fruition in Q3 or Q4.
Yeah, just to add to a little bit of that, I was on with Michelle Gibley, who was our Director of International Research at CIFRA, Schwab Center for Financial Research, and they're looking for they would like, if you're going to have exposure, maybe a little bit more cyclical exposure in Europe, and they were suggesting maybe for the long term, take a look at something like European financials, which are cyclical. And the one that she mentioned was EUFN there.
No, that's a great point. I think that is great exposure. So it's a little bit more focused, and I agree with that, Lee.
Okay, let's see what else is moving. Okay, internet's worst. We've been watching the Chinese internet stocks. Let's see how they've been doing. KWeb.
Yeah, and it was interesting. They were just talking, you know, all the different rhetoric between America and China. It fortunately has died down a little bit, but as we get close to the election, will you see that potentially uptick a little bit? I think the answer may be yes.
Yeah, and we'll see. But right now, what are you going to do? I think probably follow that 10-day moving average on that one as it continues to
Yes.
climb. Okay, let us take a look at
Look at EEM real quick. I'm interested in emerging because we have this weaker dollar, and emerging market has been quite the roller coaster here. We don't own it right now, but it is interesting to see technically where it's at.
Yeah, it's getting some recent relative strength here. Of course, some of that, China was up 6% in one day a few days ago, and that is the biggest weighting. I think 40% of this is China.
Yeah, I think you're right here. I'm going to pull it up at the same time. We're going to race, Lee.
Yeah,
I think you're going to win.
yeah. You can see Alibaba 7,
Yep.
Taiwan
10
7.
cents.
Yeah,
Yep.
yeah, they're all in there. So yeah, but there you go. It's a breakout from a triangle. It suggests the move up to that 45, which is the measured move from the triangle, and also the old highs. All right, continuing our survey here.
And one thing that's interesting, is not a chart that I follow a ton, but soybeans. Soybeans has been interesting. As we saw earlier in the year, the Chinese only fulfilled about 13% of their commitment or 13% of their purchases. And in the lieu of some tough conversations, they've talked about increasing that. So we did see initial pop in soybeans, but now we're seeing a little bit of a languish. Maybe there's not the follow through in those purchases potentially.
Yeah, so we did break out. We'll see if we test the breakout level and hold. That might be an entry if you think they're going to increase those purchases, right? So, yep. Let's look at cloud computing. I know you've probably got a lot of that in your software ETFs.
Yeah, we do. So we'll use IGV for that, but we look at names like Adobe, Salesforce. Of course, Microsoft is tucked in there pretty significantly at 8.5% and a weighting, but Intuit, Electronic Arts, Workday. These are all names. DocuSign. It's amazing to see how DocuSign. We're actually using that now on Schwab for clients. So DocuSign is kind of it's been unloved, but it's such a function where I think all the business will be going to DocuSign. But yeah, I think Workday is an interesting name. Adobe, is hitting all-time highs. Salesforce hit all-time highs yesterday. So these are names that are going to continue to attract assets as we kind of figure out what business looks like in the wake of COVID-19.
Yeah, I mean, they're just been on a tear. The ETF,
on fire.
They're on fire. And there's the ETF just for the cloud computing stocks. I got one more minute. Any last one you want to look at?
Well, if we want to talk about healthcare, XLV is an interesting opportunity, and we've seen a lot of assets pour into the space. If you kind of pull out the individual names in here, of course, you have all the big boys: Johnson & Johnson, United Health. United Health has had a great year, but we talk about some of the other ones. If it's Amgen, if it's Eli Lilly, Bristol Myers, I think these names continue to do well, and they were laggards for a long time, Lee. I mean, some of these names are really beat up, and will they get beat up again if we do see a switch in presidents? If we see it go from Republican to Democratic, that was a big deal. If you remember a couple of years ago when Hillary Clinton was in the polls, healthcare got smoked. So I don't see XLV really breaking any of those technical levels going lower. I think this is an ETF that we continue to own. We own it in our ETF model portfolios and our sector rotation. But healthcare is, I get fascinated by healthcare when you kind of talk about the election year. No one's really talking about the election year. We have so many other things to talk about, but we're only a couple of months away from this thing really getting crazy, Lee.
It is. And oh no, our time is up. It goes so fast when you're on, Jeff. So thank you so much for spending some time with us today.
All right, Lee. Thanks for having me as always, my friend.
Alrighty, coming up next with an hour break, 3 p.m. Eastern, option market recap with one of our derivatives specialists, Nate Peterson from the Schwab Center for Financial Research. So stay tuned.
Okay. Bounced a trade idea off my firm. Same old lines. I mean, show me some technical indicators, proprietary research, something.
That's why I like Schwab. They help look out for your blind spots.
Come on, Johnny, you got this, buddy.
Speaking of blind spots.
It's time to trade up. Schwab helps you see the full picture with powerful intel and trading specialists who get it. Plus, get commission-free online stock, ETF, and options trades. Schwab, the better place for traders.
At any point in time, stock prices are trending upward, trending downward, or trading in a range. And really, that's it. As a trader, it may be useful to know which of these scenarios you're seeing. Technical analysis uses charts to track price and volume ranges over various time frames in an effort to gauge which way the stock may move. Identifying these trends and price action can help you decide when to enter a new trade or exit an existing position. For the technician, price is king. Technical analysis can help you take the emotion out of trading because it assumes that all of the news, the earnings potential, and consumer sentiment are already baked into the existing price. This means that you trade based on what you see happening, not what you believe should be happening. Because psychological factors can also drive markets and are often predictable, technical analysis uses charts to offer a picture of how markets act when a stock reaches certain price levels. By watching for changes in price action and trading volume, you can gain insight into what other traders are doing, and that can help you make better decisions with your trades. So let's look at an example. If a stock has a history of retreating to $50 per share and moving higher from there, you could enter your trade near the supporting price of $50 and look to sell once it moves higher. Keep in mind, you shouldn't rely on past performance to assure success no matter which indicator you're following. In this example, you would want to set your stop order just below this $50 level to help limit losses in case the stock were to reverse and fall through our support level. Falling through this $50 level of support would be a clear departure from what the stock had been doing. It can indicate a shift in sentiment, meaning many traders might have lost interest in this stock. And once that happens, the price could continue lower to its next level of support, making your stop order very important. And remember that there's no guarantee that your stop order will be filled at or even near your stop price because once it triggers, you're entering a market order. Keep in mind that technical analysis is not a guarantee of success. It works best when you use a combination of tools and indicators to get a full picture of what the market is doing.
So Schwab taught me about four-legged option strategies. I'm gonna go with an iron butterfly spread on that fintech stock.
Nice. I just tried an iron condor.
Only spread I've been introduced to is this onion chive.
It's time to trade up to Schwab, the firm invested in helping you become a better trader. Get commission-free online stock, ETF, and options trades. Expect more from your firm. Schwab, the better place for traders.
Hello and welcome to the Quick Start video for the Chart tool, available on Schwab's Street Smart Edge platform. Street Smart Edge has advanced charting